what perspective would you have if you're just pitching life insurance as an asset to like why Americans should lean more into it and why it could potentially be an amazing asset for your household and for your portfolio?
Yeah. So I wish people would appreciate more the power of compounding. I think sometimes folks get too distracted by, well, I could get 20% in a year, 25% of the year, and they lose sight of the power of just contributing annually every year and watching something grow over time. I can't tell you how many people I've talked to that maybe bought a policy when they were 26, kind of forgot about it.
Yeah.
And then they go look at it when they're 55 or 60 and they're like, I got $250,000 in there.
Yeah.
So that's one, just the power of compounding is really important. When I think about it, I always talk about the three legs to the stool. You've got the death benefit, the tax benefit, and then if you need it, you can access the cash. And to me, whether that's IUL, whether that's whole life, that those three legs hold in that stool. I think some of the things that I worry about is when agents push too hard on one leg and don't look at it whole, stool on one leg is not going to stand up.
That's right.
Right. So in our business, that was one of the things that fascinated me when I came out of banking into insurance is, we're pushing a bunch of commission over an agent to sell something. And that can cause people to oversell.
Yep.
That can cause people to explain one of the stools that that they think this client's interested in, but they don't talk about the others. And is that business going to persist? So that's something that we watch very carefully. I think agents can wrap those three legs of the stool into their story any way that they want to do it. But I feel like it's important. You got to do all three.
Yeah.
Back to your question on insurance as an asset. What I think is great about the product is, particularly in dealing with business owners, they're taking a lot of risk in the business, right? Or they may have money in the stock market and other places, which are great.
Yeah.
This is a very safe place to put their cash, put their money.
Yep.
And at the same time, if they do own a business, they're likely going to have some type of transition plan, so it can help to fund that as well with the death benefit. So I think sometimes people just look at insurance and think, well, it's an unnecessary expense. I don't need it. I'll invest here or do that. And I just wish people would stop and really think about all the benefits in the three legs of that stool. And, some of the data that you've probably seen as well is when people are wrong about the cost of insurance, they generally are wrong by 4 or 5 times. So if it costs $500, right, they're thinking it costs $2,000. And that's a massive gap in terms of understanding. And so that's where it ties back into how many agents do we have in this business? Because if we don't have people out there talking about it, if ownership rates across the population continue to decline, that threatens the popularity of it in terms of people wanting to get into the business. So I think that's really important.
What do you say to the financial gurus out there that are very, very anti-life insurance annuities and pretty much equate people that pitch or peddle whole life, IUL, fixed index annuities as scum of the earth and scams? Right. Yeah. Like, what is your thought? Because it's not directly attacking you, but it's indirectly attacking you. What is your thoughts on that?
So again, I kind of go back to this whole thing of it's a philosophical way of looking at things. Yeah. Okay. So if you want to buy term and invest the difference, that's a philosophical way that you want to think about your finances. Can that work? It can work.
Yeah.
I'm not going to sit here and tell you that it absolutely does not work. You've got to be disciplined. You've got to be willing to save the money so that when your term burns off, you've got enough money there to protect your family and to do everything you want to do. What usually happens is most people don't have enough, right? And so now that term burns off, they're 50 or 55, and now they do need that protection. And it would have been a heck of a lot cheaper if they would have bought it permanent when they were 40 or 45, and it would have been there to do all the things they want. Plus they've got it, later in life when they really need it. So I see a lot of people that bought into the buy term, invest the difference younger, and now they're coming into buying permanent. They're like, man, I wish I would have done this earlier. Or I wish I would have done this before I developed a health condition. Yeah. So I think that when they vilify it, I think it's because they're just so anchored in their belief system in terms of what they think is important. I think it's wrong to vilify it, just like I'm not going to vilify the buy term, invest the difference.
Totally.
I think it's put all the cards on the table and say, here's an option, here's why I think this one's better for you.
Yep.
And plenty of people think that it are. And that's why we, sell a lot of IUL and whole life, because it is.
Yeah.
But you need people that can walk through that and understand it and not just pigeonhole someone in that just because that's what they're selling. They've got to be able to talk about the other things.
For you personally, and I won't ask you any personal questions around your portfolio and holdings, but I'm assuming you have life insurance.
I do.
How do you think about it for your own personal life and your family? And how is that positioned in your portfolio?
So I think about it as a way to de-risk my investments. It's a sure thing that I can count on that will be there to care for my family and do whatever I want to do. It's a great way to pass on a legacy. When I retire, I want to be able to go do things with my wife and enjoy the money that we built up over time, but I also want to pass on something to my kids. And so that just simplifies the financial planning, because I know that my insurance, my permanent insurance, is going to be there to do that. And I think that's the beauty of it. I also don't know where tax rates are going to be 10 years from now. And so if you're thinking about the efficiency of accessing the money in the policy when you hit your retirement period, it's a hedge against future tax rates. And I think that's frankly why a lot of people are interested in the product now, because there's been a lot of talk about tax policy and where taxes are going. So I think that's an important part of it too. And I talk to so many people. I'm 52. A lot of people in my age range where their term's burning off now and they got to do something and they're just kicking themselves. Like, man, why didn't I get a permanent IUL or whole life, when I was in my 40s? It would have been a lot cheaper, a lot better.
Diversification is one of the key tenets to almost any successful investor. And I can't think of, again, institutions that are better diversified. So even if you look at insurance, you're diversified not just on rates and different asset classes, but you're diversified on mortality as well. And you have a lot of data. And so one of the big, I would say, selling pitches of just mutual insurance carriers that have been around over 100 years, that have been consistent paying dividends, is safety. Can you help us unpack what that actually looks like from a standpoint of like how safe are insurance carriers compared to other alternatives? And then what are some of the events that you worry about from a president of the standpoint, because you're on the hook for a lot of promises. And so like, again, I know I'm asking like 5 questions in one, but I would just love the viewer to understand more of like why whole life insurance, why mutual insurance carriers, like where are the pluses, but where are the things that you guys are looking to? Because there's no such thing as a bulletproof institution. But I always say that insurance companies will probably be the last institutions to fall. I'm not sure if that's an overstatement or not. Hey, it's Caleb Williams here. I'm just interrupting this video quickly to invite you to check out our And Asset Vault. You may have been there. We've actually revamping it. And if you are somebody that wants to learn more about, is life insurance the right fit for me? Does this And Asset make sense? Like, does this actually help me be more efficient? We've put together a 10-minute documentary style video that I think does a really, really good job giving the history, why the And Asset, different setups and designs that we use. And then we have an And Asset Vault that gives like case studies, calculators, handbooks, and so much more. We are here to serve you, whether it's a conversation, whether it's education, or the video. So make sure to go check out andasset.com/vault, learn more.
No, I think I wouldn't say that about all of them, but I think in general, it's a very sound and safe industry. What I would start with, and this is something we tout all the time, and I would say Western and Southern Financial Group's one of the strongest insurance groups in the nation, if not the world, over 14% capital asset ratio. And so just that stat alone provides a significant buffer against what could go wrong.
And what do you mean by that? 14% capital.
So the amount of capital we hold is 14% of our total assets, right? So just think about that for a minute, right? So when you look at publicly traded life insurance companies, and this isn't an exact stat, I'm directionally correct, I think their average capital asset ratio is around 3.8 or 4%. So if you think about how much an investment can move, stock, bond, and you've got a 4% cushion versus a 14% cushion, that kind of tells you what I'll call the buffer between events occurring. Now, there's a difference as to when you got to mark everything to market. Your equity holdings at an insurance company are marked to market every month. And even though if you don't sell them, they're reflected in your earnings. So it's going to add to your capital base depending on how that cycles through. The bond portfolio is not marked to market every month. So you could be carrying either big gains or big losses, and that's not going to show up in your net worth every single month because they're not changed. But the important thing is that most insurance companies are well diversified in terms of what they invest in. We just want to be that company that no matter what storm hits, we're there because we maintain those buffers. And that's something that's just core to who we are. And we don't ever want anyone to have to worry about whether that's going to be there or not when things happen. What it is that causes that to occur, when it's going to occur, it's hard to say. Obviously, if I could predict the future, I would do a lot of things different. But we just want to make sure that we're ready for anything that comes our way and that we're going to be there and people can count on it.
When you look at like the type of assets that, like, let's say Lafayette Life Insurance, from a pie standpoint, where are most of these investments being held? And
So biggest percentage is going to be in highly rated bonds, right? That's the bastion of where insurance companies tend to invest. One of the challenges we have in the insurance company is finding long duration assets. Like in Lafayette, we can't invest long enough, right? Because the duration of our stuff is at least 25, 30 years in general. So, to find a bond that's going to pay well or even that goes out that long is very difficult. So we try to match our duration as best as we can. So, 65 to 70% is going to be in bonds. To generate the dividend that we generate, we will own some high quality equities, right? Names that we really believe in it with conviction over time. And I think if you look at equity performance over time, it's going to outperform the bonds. You're going to have more volatility.
And because you have that buffer, you can make those moves.
Correct.
And it's still not put the entire company
doesn't put the principal at risk. Exactly. Yeah. If you look at the Western Southern level, we carry a higher percentage of equities than most of our peers because of the superior return profile over time, because we have more capital and because they're very liquid, right? If you needed access to that cash, if you own a baseball team or you own part of a company, if you need that money, you can't turn around and sell that right away, right? So it's not as liquid. We also do some CLOs. We do some private debt funds, is again a way to get slightly higher returns. Those are going to be very small percentages in these portfolios. I kind of view them as a little bit of juice in the portfolio to kind of help get the yield up. Policy loans are part of our investments as well in terms of where the money is. And then we do have some real estate. Mostly for us, it's going to be medical, single family. We don't have a lot of office exposure, fortunately. So,
what are your overall thoughts on policy loans as an asset? And again, you can decline to answer that question if you want. I know that there's some people that watch this that have outstanding loans. There's a lot of people that don't, and it's always interesting to, like, one of the things that we say is the reason why they charge interest. So if they didn't, it would be a horrible thing for a mutual insurance carrier to be an owner,
and for the policy owner,
and for the policy owner. So it's like you fundamentally you need to charge interest that you have it make sense. What are your thoughts from a president of an insurance carrier? Like, what do you view and how do you view loans, the pros and cons of it?
Sure. So I go back to the three-legged stool again, right? It's death benefit, it's tax advantages, and it's access to the cash. When somebody needs access to that cash, it's their money, they put it in. Our big thing is we want to see them pay it back because we want the policy to persist and stay on the books. If they suck everything out and they're just barely feeding that thing along, some type of event happens in their life, chances are they're not going to be able to keep paying. It's going to lapse. So persistency is a huge driver of our profitability. Again, back to the amount of commission that we pay out up front, we're counting on that thing being on the books. And the economics for an insurance company is you're maybe starting to break even around year 3, year 4 on that policy. So you need it to be on the books 7, 10, 15, 20 years to get what already is a lower return. Right. So that's why it's such an important factor for us. So when we see what I would say are irresponsible loan activity, where the money's just being sucked out and then the client isn't committed to keeping that policy, that's where we start to have some concerns.
And it's like, really, if you think of life insurance as a foundational asset,
correct,
why would you want to create problems, chips, and all these things? And that you should want it to be as foundational as possible. A lot of times it's not sexy. We're in a big building now. We can't see the foundation. But it needs to be deep for us to build on top. And I personally think your financial life, like, there's a lot of people get seduced by returns, but a lot of times we don't think through, like, hey, how do we build the personal financial foundation? I think life insurance is an asset class that's a phenomenal asset to look at as a tool to be able to do that.
Yes, it is. Yeah. And I think the best agents that we have are ones that I would say focus on those 3 legs. They're willing to tell a customer no. So if it feels like they're forcing it and this just is not a good fit for somebody, either because they're not disciplined to keep paying into it, or they have the wrong perception about how to access the cash and what that looks like, then those many times are the ones where it's best to just move on, because then as the agent, you're going to spend a ton of time reselling that down the road if the client got in for the wrong reasons. So